Following the week in which Warren Buffett announced he would be stepping down as CEO of Berkshire Hathaway, it seems highly appropriate that this week's episode of the Investor Insights series focuses specifically on the philosophy of value investing. Pioneered by the academic work of Benjamin Graham and David Dodd in the 1920s, and practiced by many successful investors, including the stewards of Berkshire Hathaway ever since, Buffett's famous repeated line that price is what you pay, value is what you get, succinctly phrases the key concept that value is the key determinant of whether an investment will be successful. The methodology, when practiced in its purest form, requires a contrarian mindset that looks to exploit the irrational behaviour of investors in order to identify and buy securities priced below their intrinsic value. We were delighted to record a conversation with Nick Kirrage, the experienced head of the Schroder Global Value Team, to explore this further. Welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik Co YouTube channel, or by searching for Killik Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were joined by Nick Kirrage, head of the Global Value Team at Schroders, which as a group manage over £10 billion sterling across a range of equity strategies, all of which are run with a contrarian and pure value style, and with dedicated products covering the UK, global, European and emerging markets. Nick was a founding member of the team in 2013 and is the co-manager of the Schroder Income and Schroder Recovery funds, and has managed value portfolios at Schroders since 2006. Regular listeners to the series will have now heard from a variety of portfolio managers exhibiting some very different investment styles. And I hope one of the key takeaways from the recordings is the different skill sets, mindsets, and even personalities which play a role in leading to the successful execution of each approach. Our conversation with Nick adds yet another differentiated approach into the melting pot. Global markets can experience prolonged and significant evolutions in the market leadership, and the turning points in such drivers can be very hard to predict. On occasion, they're triggered by changes in major political rules, reversal in central bank policy, and the evolving forecasts in economic outlooks. We continue to believe investors are well served to diversify their portfolios, not just by traditional methods of asset class and geographic exposure, but also through the lens of investment style factors and by underlying growth drivers. The identification of well-considered, specialist proponents of these styles and managing their exposures through time can have a significant impact on the investment journey over long holding periods. We hope you enjoy this discussion, and please do get in contact if you'd like more information about any of the topics or financial terms referenced in this conversation, or to further explore the fund strategies in question. Hi, Nick. Good morning. Thank you so much for sparing some time for this. How are you doing today?
I'm doing well. Summer has arrived in the UK, which is always a nice week.
Yeah, very sunny Monday morning. Yeah, thank you. So we got this kind of regular kind of opening question to these. It just tries to get a bit to know you, really. That's the kind of aim of the question. I wondered if there was a kind of anecdote that you could share from a recent research project or some research work that you've been doing, or recent meeting or trip, or even just a book or article that you've read, anything that you could share just to give us a bit of an insight into how you go about your work.
I mean, the thing about this job is that it's one of those jobs that if you're really passionate about it, which most investors are, you're just always reading. The weekend is, the FT weekend turning up's the best hour of my week, getting through that with a cup of tea, and the kids are yet to get up. So what I would say though is that I don't think there's any one thing. That there's fascinating things all over the place, but I was just looking back, as you were asking for anecdotes and stocks we look at or research, and I was just looking back. We write notes in what we call our value archive, so we can learn from the work that we do going forward, whether we buy stocks or not. And in there, I looked at the last 2 months in terms of the companies. I'd written something up on them and put the valuation in, and decided to buy it or not. But it was just the breadth there. EasyJet, Ryanair, Bank of Ireland, a couple of UK retailers and Tesco and Kingfisher, a Japanese pharmaceutical business, Ono Pharma, and a kind of North Sea offshore E&P business. So just what a privilege to be able to kind of look at so many different interesting investments. And I think I stand by kind of maintaining a very broad perspective on what you're doing. It's very easy to become very narrow, very deep, very quickly, and slightly miss the wood for the trees in investing. So, you got to kiss a lot of frogs in investing. We're constantly trying to turn stones to try and get the best high conviction ideas we can.
Yeah, always very varied and going around the world and across industries. Yeah, no, thank you for that. So Nick, just to maybe frame the rest of the discussion, perhaps for some that aren't so familiar with kind of the approach, and maybe a refresher for those that are, could I ask you just to summarize the kind of broad features of the approach that you and the team use? I'm conscious that kind of value investing can come in lots of different forms, just how you see yourself kind of sitting on that kind of spectrum. Could you give us a summary of that?
Yeah. I think this kind of broadening out of what the value investing is to people has happened a lot in the last 10, 15 years. We've still got, those kind of deep value, Ben Graham, cigar butt type investors. And then at the other end, you've got people buying NVIDIA saying, this is why I'm still a value investor. So it became a very broad church. I think what we believe in ultimately is that the reason we're value investors, and value to us is looking at lower valuation, screening the market for lower valuation companies and asking, what if this isn't as bad a business as people think, or the reasons that this is trading at a low valuation today might not be in perpetuity. The reason that we do that is because ultimately value to us is a behavioral phenomenon. Things get cheap ultimately because people get disappointed, fearful, scared. And this human element, this loss aversion, is a bias that's endemic, and it reoccurs over years and years and years and years. And the stock market's an intimidating place because everything's always changing, and it's so hard to know what's going to happen. The macro, or right now the politics, Donald Trump, tariffs. I mean, how do you make sense of that and then kind of come to a view about the future? But the amazing thing about value investing and thinking about that from a behavioral point of view is, everything is changing and nothing ever is the same. And the investments themselves are wildly different today than they were 100 years ago. But the humans are the same, and they get scared and they get fearful, they get disappointed. And at the other side, they get greedy and over optimistic and euphoric. And just simply, constructing an investment process that's based on that not changing, that being a constant over time, is how it's possible to make money consistently over the long term, we think, and into the future, without needing to fully know what will happen in Ukraine, or what will happen with tariffs, or what will happen with interest rates, all of which are important, and you bake them in and you think about that and you stress test portfolios. But if you do your job right, as long as humans act like humans, you can make good money for clients over time.
Yeah, no, thank you for that good summary. I'm sure we'll come back and explore some of those points that you've just made up, particularly about the kind of human element in a later question. And Nick, a number of the funds that you and the team run have a focus on the provision of an income yield. So I wanted to kind of maybe cover off that. I've heard you in previous presentations talk about this concept of kind of complete income. I wondered if I could ask you to kind of describe what you mean by that. And I wonder if there's any kind of examples that might kind of demonstrate the types of characteristics that you're looking for when you're looking at kind of constituents for those strategies in particular.
Sure. I've seen income investing done a lot of different ways over the kind of broadly 2.5 decades I've been doing this now. And they have strengths and weaknesses, but all of them tend to fall apart in my mind unless you think about all the elements of what we call kind of complete income. So there's 3 key elements. The first is the dividend yield. Obviously, you want the dividend yield to be attractive. It's the old Ronseal test. It does what it says on the tin. I said that to one of my daughter's friends the other day, and she looked at me bizarrely. I mean, I'm clearly generationally out of date here, but we always used to call that the Ronseal test. So it's an income fund. You want to provide an attractive yield. The second thing is the total return. So there is no point in providing that yield. And I've seen income funds where the yield is 5, 6, 7, 8%, but you're doing that at the expense of capital. What the stats would tell you is that the higher the yield that you target over time, the lower the realized yield, i.e. yields look like they're going up to 4, 5, 6, 7, 8. But when you look at what you actually get after 5%, it's very hard to force things up. It does get higher, but it starts to level off. And that's because where something looks like it yields 8, it doesn't actually yield 8. The market is telling you the dividend's going to be cut, and the market is clever. So quite often it's right. And what that means is ahead of dividend cuts, shares perform quite poorly. Interestingly and very importantly, after dividend cuts, shares tend to outperform and do very well. And that's a thing that many people miss. So there's a third element to this as well, which is, yes, the capital needs to go up over time because that's what pays the dividend. And you need a decent yield each year because it's an income fund. But you also need the dividend per share to grow. So growing income well ahead of inflation. And this is an absolutely essential element, which is in some respects wrapped up with the capital growth. If the NAV, if the capital, if the price of the units goes up, there is more money to pay a growing income. So your income will grow over time. And that's an absolutely essential element. But you have to balance these 3 things. And if you don't balance and you prioritize one over another, over time, it tends to fall apart in our minds. So we're trying to think about all 3 of those things. Now, ideally, you'd go and buy this brilliant, mercurial, fantastic business. They gave you all of those, nice growth in the share price, great growing dividend, and an attractive yield. They're a bit like unicorns, really. They're very, very hard to find because when you have the attractive things like dividend growth, you tend to be lower yield over time because you're more expensive. And therefore, if you're more expensive, your capital doesn't grow as quickly either. So it's it's quite tricky to get the Venn diagram to overlap. What we do here is we make sure that the stocks we are investing in have the ability to pay a growing dividend over time, will compound capital over time, and have what we call a normalized dividend yield that could be high. But we are conscious that one of the best ways to get dividend growth into a portfolio, and something that the market, one of the big drivers of dividend growth in the market, is companies that have cut their dividend coming back to the register. And many income investors avoid that because they say, well, I'm not going to have it unless it's paying a big dividend yield today. And we would say, if it has the potential to pay a big dividend yield, potentially it could be quite cheap today. So we get all of this together. And the apocryphal example over the last 5 years has been banks. Banks have been a sector which was, dividends were cut to almost zero 10, 15 years ago. They really struggled. They had to spend all their money repairing their balance sheets and sorting themselves out. And if you had bought them 3 or 4 years ago, looking through to say, but these are actually cash cows, they're just hiding. Today, you're seeing extraordinary dividend yields and extraordinary dividend growth. And you've seen great share price performance. So that's what we're trying to do. We're trying to balance the portfolio so that we can get complete income to our unit holders.
Yeah, thank you for that. Some really interesting points in there. Nick, my next question mentions that 2-word phrase that I hope doesn't kind of haunt value investors, and it's the value trap.
Yeah.
I wondered if I could just ask you the obvious question is kind of how do you look to avoid a value trap? But I wondered if there were kind of techniques that you employ to assess, I guess it's downside risks that you're looking to kind of protect against, or even just manage the risk across the portfolio. Are there any kind of ways that you kind of look to go about that?
Look, I think that the first thing to do, there are many ways we go to try and avoid that. We've got a process that's basically set up explicitly to try and weed out the value traps. But I think the first thing you do when you wake up in the morning, if you want to be successful at investing, is accept the fact you're going to get it wrong. And you're going to get it wrong a lot more than many of your clients understand. And that's very, very difficult. So, broadly, if you go and buy 40 stocks for a high conviction portfolio and 22 of those were great investments and 18 were really bad investments, and you could maintain that marginally better than a coin flip percentage. So you were right 55% of the time, let's say, and you did that every year for 30 years, you're probably in the best 10% of investors who have ever lived in the history of the world. Whereas I think many clients, if you said, I'm one of the best investors who's ever lived in the history of the world, and I bought 40 stocks, would say, and you said, how many are winners? They'd say 37. The truth is, but what we're trying to do here is very, very difficult. There are a huge number of variables we're not in control of, and it's probabilistic. So what do I mean by probabilistic? If I behave in a certain way and I buy an investment today, it's possible that I lose all my money in that investment. But the lesson to learn isn't don't ever do that again. It's do that again every time. Because what I want to know is if I did that 100 times over an investment career for my clients, would I be right 60% of the time? So the constant question is, was it bad process or bad luck? And we're constantly trying to ask this about how we do what we do. So, come back to where we started about value traps. We accept that when we fish in the cheapest part of the market, the cheapest 20 or 30% of the market, looking for where that loss aversion's high and where there's maybe diamonds in the rough, there's just rough in the rough too. And there will be several investments there that go on to be disappointing. Very few do you lose all your money in actually over time, but ones where you don't make an above market return, an attractive IRR over the next 5 years, there are several, there are lots of those. So we're trying to weed those out. And we have a process that we call the 7 red questions. And it's this concept called red teaming, which we stole off the US military, which effectively is a checklist of ideas. The US military have this idea, well, when they put together a plan for an engagement, they then having done that, they then give it to a group of people in another room who are not involved in coming up with a plan. And they ask those people, come up with every way this is going to go wrong, that we're going to lose people here. And what that does is enables you to think ahead of time, here are the weak areas of that plan. And the second thing is, in a world where you don't really control how battles go, in the same way you don't really control what the stock market's doing, you can think about what you would do if it did go wrong and how it might go wrong. So we ask these questions of all our investment, and it is a kind of robust way for us to say, this is basically every way we've lost money in the past, investing in stocks, the questions we wish we'd asked of the value traps. Let's ask these questions ahead of time. And every one of these questions helps us understand some element of the risk and the reward. And then we compare risk and reward to decide whether or not we're going to buy a stock. And I know that sounds ridiculously simple, but to quote Richard Oldfield, not the boss of Schroders, Richard Oldfield, the famous value investor, Richard Oldfield, simple, but not easy.
Yeah, no, absolutely. And that lays out it really well. Thank you. Nick, in a previous question, you talked about some kind of top-down factors, and I wonder just kind of, it's very clear already from kind of how you've been talking that the process is very kind of bottom up in analysis, even right from that first question that you answered. But I wonder just kind of how you evaluate macro or top-down factors. There can be kind of some quite prolonged periods where, thinking of kind of tariffs at the moment, where top-down factors really kind of seem to be driving the market more than anything else. Kind of how do you evaluate those?
Yeah, so it's a great question. I remember in my youth, I used to quite like replying to this question with, we don't think about macro. We're totally bottom up. Macro factors, you can't understand what's going on or control them, which is kind of true, but glib and ridiculous. The truth is, when you invest in any company, whether or not you want to take a macro view or not, macro is going to happen either way. What we tend to try and do is, there are certain sectors and companies where it's impossible to not take a macro view. So if you're investing in BP, not taking a view on the oil price, it digs up oil. So you kind of, if you're going to have any type of view of trying to understand what you think is a normal level of profits from this business over time, you're going to take a view. Ditto Anglo-American or Rio Tinto in the iron ore price. What we tend to do in those cases is take a kind of very long-term view, which is to say, what are the average prices of these commodities over 20 years adjusted for inflation? Because over the very long term, we tend to balance out the fact that it gets harder to get things out of the ground with the fact that we get cleverer at doing that. And many people who listen to this podcast will have been being told, much like me, that we were running out of oil since I was a child. Yet today we have no problem digging up oil because we've got better at doing that and cleverer at doing it, fracking et al. So there's that. The other side is just broad macro. So interest rates, for example, on banks or tariff rates or inflation or whatever it might be. In most cases, we try to think about them as risk factors. These are ways we might lose money over time because it's eroded by currency moves or inflation or whatever it might be. And we factor that in. We tend not to say, this is our bet on interest rates going the other way, or, we're hoping here that this is a good inflation play. We think about how these factors affect the businesses we invest in, and we try to ensure that if things go against us in very negative ways, that we won't lose all of our money, or that, put another way, there's still a way to make money, even if that goes against us. So come back to trying to be right 55% of the time. We're trying to construct a portfolio of somewhere between 40 and 60 stocks, where each idea is heads I win, tails I don't lose too much. And we aren't in control of whether it comes up heads or tails. It's important to accept what you can't control about the future. We don't know. But if we're good at setting this portfolio up, we're sensible about diversifying and the drivers of the various different stocks, then it won't matter which way it comes up. We can still make money for clients.
Yeah, absolutely. Nick, we've asked on this series of interviews to a few people a question about kind of how their respective strategies have been impacted by some of those kind of quite long-lasting trends that we've seen kind of underway in markets over the last several years, really. That kind of increasing concentration, the kind of the mega caps, or even that rise in passive investing, that rise in market share of passives, or just even the pure fact that the aggregate valuation of the markets kind of is above average, and that kind of dispersion between the US and the UK or other parts of the market. I just wonder kind of how you view some of those factors and the outlook for value investing. I'd just be curious to hear your answer to that.
There have been some quite big shifts over time. I mean, the enormous ones have been the dominance of the US in particular, going from half the global index 15 years ago, whatever it was, to over 2/3, now more than 70% of the global index. The strength of the dollar has been kind of enormous. The rise of kind of valuations of technology and certain in demand and quote unquote winning sectors. These have created some quite big imbalances. Whether or not that's been driven by passive flows and so on and so forth, I would say that from our perspective, I always kind of say the same thing, which is we don't really get to make excuses over time. We are subject to a certain style, and we're horribly honest with our clients and transparent. We don't ever try to be anything other than what we are. And for most clients, they want us to stay in that value space because they'll have other investments in the more growth space or different. So we're doing something very consistent. As long as we do it consistently and generate a return over time, they're comfortable. But they have created a very difficult headwind for value investors, which I think today we look at relative valuations and think that there is an incredible opportunity in the long term in kind of value and value rated stocks. The difficulty with this is always, you don't know. Something I hear a lot from people is international markets, the rest of world versus the US market. The US has been outperforming the rest of the world for 15 years. That's longer than many people's investment careers so far. And it's hard to challenge that. And yet in 3 months at the start of this year, that doctrine has kind of reversed. Now, will it be a long-term reverse or is it a short-term reverse? I don't know. But what I find really encouraging or find interesting is suddenly everyone wants to ask that question. Whereas 6 months ago, I was I remember going marketing in the US and I overheard a client say the immortal line, "What is it about international markets? It's the punchline to every joke." So, things do change. And when you get these profound and significant shifts, that's when you can make the most money for clients. So, we continue to kind of plow our furrow, recognizing we can't make excuses, but understanding we have to operate in the market in which we're given and the universe in which we're given, do the best possible job for clients. But I would say I'm very optimistic on a kind of 5-10 year view, given what we've seen over the last 10 years, that there will be plenty of opportunities for value investors in the future.
Yeah, no, thank you for that. And then for the record, we're in that camp of clients not wanting you guys to change your style in any way. That's certainly what we're after as well. So thank you. And Nick, our standard final question is another one we've asked most people on the series. We've asked you a lot of top-down questions, so I'm going to ask you a kind of bottom-up one. I wondered if there was a kind of area of your investment universe that you have a particularly high conviction in at the moment. Kind of where are you finding the best opportunities? Can we finish with that?
What we like is areas where there's been, people have said something for a long period of time and suddenly that looks like that's changing. And I think one of those areas is kind of luxury goods. So we've sat here for much of the last 25 years in a kind of environment of premiumization, growing middle income, wealth effect, the high end, people at the wealthier end of the demographic spectrum getting wealthier and spending a lot of that on Hermes handbags and whatever it might be, Burberry Max. And suddenly we've seen a bit of a downturn in that, and we've seen people questioning whether or not the multiple they should pay for these kind of businesses. And you immediately start to hear things like, is the brand broken? I think there's a lot of stocks in that luxury complex where we're starting to see opportunities potentially to buy into brands which have been around for decades, and in some cases, hundreds of years. There are not that many of them. It's quite hard to create a new brand from scratch. Heritage is important in this space and sector. And where there are stocks that look like, it may be a bumpy path, it may be difficult, but we're on a 5-year view. We think there's some quite big opportunities emerging there. It's not the only consumer discretionary space. There's a lot of, people are worried about consumers more broadly, whether or not that's retailers, whether or not that's auto manufacturers in the supply chain, demand for cars, whatever it might be, there are other concerns. But luxury is one that's kind of, it hasn't been, when it hasn't been on your radar, it hasn't screamed for a couple of decades, and suddenly they pop up. The opportunity to maybe buy into businesses. People sometimes think value investing is all about dash for trash is this phrase I've heard a couple of times, all the rest of it. I refute that aggressively. I mean, you've had a chance to buy 4 of the Mag 7 in the cheapest 20% of the market at some point over the last 12 years. You may not have done it, but Meta was there 2 years ago. Apple, Google, Microsoft, they've all fallen out of favor and fallen back into favor. So if you are, you stay frosty and you stay really patient, and I mean patient in years and decades, then you get the opportunity to buy good businesses at really attractive prices. It's just at the time everyone's really worried. So right now, that's an area that we're kind of big back about.
Yeah, no, thank you for that. And it's a really important point right at the end of how these great businesses do cycle around and come into that kind of value bucket for sure. Nick, thank you so much for your time. Really appreciate you talking to us.
No, it's all. Thanks for having me.
Thank you for listening to the Investor Insights podcast, hosted by Killik Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.